Right. Good evening, everybody. So let's start again group accounts discussion. Actually, last day we started group accounts, and as I remember, we went through the slides. And today I am going to discuss some other adjustments relating to group financial statements, especially relating to statement of financial position. Right. So then, accordingly, if you can remember, I think we started business combinations, and I told you the importance of business combinations or business acquisitions, mergers, absorptions, etc. And we learned what is amalgamation, absorption and consolidation of financial statements last week. And also thereafter, I'm recalling last week one, we learned about different types of investments made by one entity in other. Accordingly, I told you about simple investments. Usually we refer it as the acquisition percentage is less than 20%, we call it simple investment. If any entity is acquiring more than 20% interest or controlling power of another entity and less than 50%, usually we refer it as investment in associates. But this is only kind of condition we take. There are some other conditions. And if any company is purchasing more than 50% of controlling power of another entity, we call it usually subsidiaries. From that point, we came into investment in subsidiaries. In that case, we learned several definitions about parent, subsidiary and sub-subsidiary. These are the terms we learned. Accordingly, if you can remember, parent, it is the entity that has one or more subsidiaries, or the entity which make investment in other entity to acquire shares or controlling power of the business. So then there is another, then this the acquiree will become the subsidiary of the acquirer. Right? So then if acquiree purchase another company shares, that it will become the parent, but other one will become subsidiary. The third one will become the sub-subsidiary of the main one. So that's what we discussed about in the last week. This will become subsidiary of this entity called parent. The whole picture we call group financial statements. I told you last week, the last day, all these entities will prepare their own financial statements, right? But remember, the parent has responsibility to prepare a separate set of financial statement which is known as group financial statement, in addition to the A's financial statement in my example. Right? So A should prepare his own financial statement separately, but in addition to that, he has to prepare consolidated financial statement having its all subsidiaries and sub-subsidiaries. So then that is what we are trying to do in the form of group financial statements. Right? Can remember we learned sort of terms also again about non-controlling interest we discussed. I'll come to that point later with a question. We discussed these. So then we went through, so actually now my plan is to discuss some adjustments or theoretical points relating to group financial statement with small questions. Right? Small questions. Accordingly, with the first question, if you can remember, we learned the term called cost of control account. You can remember what's the purpose of cost of control. It means this one. The purpose of cost of control is to, the purpose of this is to calculate goodwill or profit on bargain in purchase at the time of business combination is happen. Right? When the investment is made by one entity to another. So then I told if you can remember, when if you take simple exercise like this, let's say if you have 10 net assets and 10 assets, and let's assume equity 8 and what is called liability. This is liability, this is equity. If you can remember, I took this one, I discussed about this kind of example. This is total assets. Look now, if I need to buy this business, I have to pay minimum of 8. That is net assets of the business. Let's say if I pay let's say 11 to buy this 8 worth of business, so this extra 3 we call This extra 3 we call, what is it? It is the goodwill in business combination, in business acquisition. Alright. So then the main purpose of this cost of control account is to calculate goodwill or profit on bargain in purchase. Then this side we take investment and this side we take net assets on the acquisition date. This side we take net assets on the acquisition date. Right, then usually we call if the net investment is greater than net assets on the acquisition, we call it net assets, then we call it a goodwill, or if the investment is less than net assets on the acquisition date, we call it profit on bargain in purchase. So that's what we learn from this point. Also, I told you we have to do line by line consolidation using equity method. So therefore we have to focus, this is equity, this is equity. So therefore we have to consolidate this equity, but we have to go through line by line consolidation having equal items together. It is to group accounts. Right. Also, I told you something about full goodwill method or valuation of fair value at valuation of NCI at fair value, or sometimes we call the same profit on bargain in purchase. Sorry, made a mistake. Partial goodwill method, full goodwill method and partial goodwill method. What is full goodwill method? You can remember we compare total investment with total net assets, or you can take total net assets, proportionate net assets with proportionate equity. So if you can remember, I told you last week how to calculate fair value of NCI if it is not given. Before that, we have to understand what is NCI. Can you remember what is NCI? Non-controlling interest means the share percentage of shares which is not purchased by the parent. We call it non-controlling interest. So if you have learned it few years back, we refer it as minority interest. Minority interest. Same thing we refer as now. We call it actually non-controlling interest. Right? Interest which is not controlled by the parent. Alright, then with that, we did discussion as I remember. Yeah, look, the way that we have taken the fair value of NCI. Fair value of non-controlling interest. If it is given, if you can remember, the double entry we learned for fair value of NCI. What is the double entry we learned for fair value of NCI? Double entry for fair value of NCI. No, sorry, this is not NCI, this is for PPE. Where is NCI part? I think it's in the next question. Last week we have learned the excess of fair value also. Now here this part also we discussed last week. Look, the double entry for excess of fair value of property, plant and equipment. Look, the double entry we have taken. Asset account debit, cost of control credit, because we need to calculate correct value of equity. Correct value of equity at the time of acquisition. I told you about profit on bargain. Here is the place where we discuss about NCI, non-controlling interest. I think we discussed this one as well as I remember. Acquisition percentage only 80%, then balance we call actually others or non-NCI. So remember I did these two questions last week. Yes, now actually up to now in group financial statements we have learned three main concepts. Maybe three or four. First thing you have to remember, we have to prepare something called cost of control account in group financial statements to calculate goodwill or profit on bargaining purchase. This is one. Second thing, we learn something called non-controlling interest, and we learn something called fair value of NCI. What is double entry of fair value of NCI? Non-controlling interest account credit or NCI account credit, and cost of control debit. It is the first double entry we learn in relating to adjustments. If fair value of NCI is given, cost of control account debit and non-controlling interest account credit. It should be the equivalent. Also another point we learn, excess of fair value of property, plant and equipment. If there is any fair value excess of PPE, we have to increase the value of the PPE, property, plant and equipment. Accordingly, the double entry should be property, plant and equipment account debit, and we should credit it to cost of control account to calculate goodwill on business consolidation. Understood? Right. Now, those are the three concepts actually, as I remember, we discussed up to now. Then remember, NCI. One more thing. If fair value of NCI is not given, how do you calculate fair value of NCI if it is not given? There are two methods of doing. If the fair value of non-controlling interest is not given, where is it? This one, right? If fair value of NCI is not given, what you can do is write it. Fair value of NCI is equal to market price per share into like this, market price per share into NCI shares. This is one method of calculating fair value of NCI if it is not given. Or if you don't have market price per share, what we can do is fair value of NCI will be equal to total net assets at the acquisition date into NCI percentage, then you can see it. This is a way of calculating it if it is not given. Fair value of NCI, one method, fair value of NCI equal to market price per share into number of shares that we have not purchased, if it is not given. And if you don't have market price per share, what you can do, you take fair value of NCI in this way, take total net assets at the acquisition date, now this is total net assets, that into NCI percentage, then it will be a fair value of NCI. Then what will be the double entry for fair value of NCI? In either way, how do you record it? Cost of control debit and in NCI account credit. This double entry, right? And also we learn excess of fair value. How to account for excess fair value of PPE? Double entries, PPE debit, and also we have to credit. Remember, we have to consider depreciation later. I will consider it later. PPE debit and cost of control credit. Depreciation. On the excess. Double entry. Retained earnings of subsidiary debit and credit to PPEO accumulated depreciation. Right? That's how we record excess of fair value of property, plant and equipment. Now you look, I have given you main 2 points. Recording of fair value of NCI, recording and calculation both, and recording of excess of fair value of property, plant and equipment, right? And depreciation on the same. I will practice it little while ago. Then there is another one. If you look the all previous questions, the acquisition date and the reporting date both are same. Acquisition date and the reporting date both are same. Now, actually, little different thing. Sometime actually we have to report after few years from its acquisition date. In that case, now in this example, even look what it says. Here, acquisition happened, let's say on 1st January 2010, and let's assume we are reporting on 31st March 2013. Look, acquisition happened 1st January 2010, but reporting date is 31st March 2013. Understood? So then what we have to see is the total profit earned after acquisition we call post acquisition earnings or post acquisition profits, or you can say post acquisition reserves. Total reserves earned prior to acquisition we call, acquisition date is here, prior to acquisition we call pre-acquisition reserves. Understand? Now we are going to learn two concepts called pre-acquisition reserves and post-acquisition reserves. Hope you understood what is pre-acquisition, what is post-acquisition. Total reserves or earnings earned prior to acquisition date we call pre-acquisition reserves. Total earnings earned after, or total reserves earned after the acquisition date to reporting date we call post-acquisition reserves. Now very simply, as you just see, who is the owner of these profits? After group accounts, the group percentage should be received to whom? To the parent. But actually parent will not entitled to have any reserves at the acquisition date because everything earned prior to the acquisition. Understand? So therefore, we need to calculate actually net assets on the acquisition date in cost of control account. This side net assets and this side investment, right, in cost of control account. So therefore, we have to remember to take all equity elements or net assets on the acquisition date to the cost of control account. Understand? Therefore, your first learning, all pre-acquisition reserves should be charged to where? To cost of control account. So therefore, very simply remember, double entry is all pre-acquisition reserves should be debited to cost of control account, and here it's wrong. This entry is wrong. Reserves account debit and cost of control account credit the total one, because we go in full goodwill method. Understand? I am deleting these now. I will show you when I do a sum. Then we are learning another double entry, third double entry maybe. All pre-acquisition reserves debit to relevant reserve account and credit to where? Cost of control account. Credit to cost of control account. So then post-acquisition reserves should be credited to post-acquisition reserves. Post means total reserves earned after the acquisition, right? Total reserves earned after the acquisition. I told you all earnings made after acquisition should be recognized. The group portion should be recognized to consolidated reserve account, consolidated reserve or consolidated earnings account, and the others to the balance part, or we call it NCI. Therefore, post-acquisition reserve should be split into two, as part goes to consolidated retained earnings and balance part goes to NCI account. You can see it here, right? Understood? So therefore, double entry. Look, first part for pre-acquisition reserve, and other one, the second part for post-acquisition reserve. Then another 4 entries already are there. I am explaining all entries that we need to pass in group financial statements first. Pre-acquisition reserves. Pre means total reserves on the acquisition date, or we call it actually sometimes total earnings made prior to the acquisition. Relevant reserve account debit and credit to cost of control account to calculate goodwill. Post reserves earned by the subsidiary. Post means total earnings after the acquisition to the reporting date. Credit to NCI percentage, and credit to consolidated retained earnings or consolidated reserve, relevant reserve account, because it belongs to the group, and debit to relevant reserve account. Understand? So we'll practice those entries with this question now. What are the entries I told you now up to now? 1. Excess of fair value of PPE, I told, PPE debit, credit to cost of control account. And if there is any depreciation, still we have not touched the depreciation area, we will practice it later. If there is any depreciation, credit to the accumulated depreciation account on under provision of depreciation, credit to accumulated depreciation of PPE, and debit to the subsidiaries retained earnings account, because already profit has been overstated, right? Then another entry we learned, fair value of NCI, cost of control debit, NCI account credit. And we learned the recent one, pre-acquisition profits and post-acquisition profits. Pre-acquisition profits debit to relevant reserve account and credit to cost of control. Post-acquisition reserves debit to reserve account, credit to group retained earnings and the NCI. So we'll practice those few with this example number 7. Look it carefully. So we are not going to practice, see one more thing. So now we don't want to focus more about this proportionate goodwill method. So therefore I am not going to do this one. I'll do only the other one. Just read the question carefully first. Right, PPLC parent, let's say, purchased 18,000 shares on 31st March 2013 when SPLC had retained earnings of 10,000. Now look, what is first point we meet here? At the acquisition date, total retained earnings means those this 10,000 retained earnings earned prior to the acquisition. Therefore, we can say this is pre-acquisition retained earnings. Now look, what is pre? Pre-acquisition reserve, pre-acquisition. We are going to practice only 2 entries in this. One is fair value of NCI, another one is pre-acquisition reserves. Now already I have told you 2 entries for these 2. What is first entry? Pre-acquisition reserves, cost of control credit, relevant reserve account means this is relevant reserve account, this is in the subsidiary. But it says out of this 19,000, very simple story, out of this 19,000, 10,000 earned prior to the acquisition. It means obviously balance after the acquisition, because now in this case, look, parent bought this subsidiary actually in year 2013. But now we are in 2015. 15 March, then 13 March, 14 March, 15 March means actually 2 years gone. Right? This date we call pre-acquisition. Total earnings after this we call pre-acquisition. Sorry, post-acquisition, made a mistake. Right, now here actually they have 10. Now the reporting here 19 total earnings. It means if it is 10 on this date, what is during this period? It is only 9. You can understand now what is pre-acquisition and what is post-acquisition, and you can write the double entry for pre-acquisition and post-acquisition. Now double entry for this 10 is retained earnings of subsidiary debit, credit to cost of control, and double entry for post-acquisition reserve, debit to retained earnings of subsidiary and credit, what is percentage? 18,000 shares out of 20,000 means 90%. You see, it's there. Acquisition percentage is 90%. So therefore, then 90% portion, it means 8,100. 8,100 credit to group retained earnings. It means we have to add 8,100 to this, and balance to NCI, and debit 9,000 to retained earnings of this, then it will be closed. Now let's see how do you do this. Look, now we do only in this method. We are going to value fair value at NCI. Sorry, NCI at fair value, made a mistake. Just see the answer. I am giving time. Right, look, first point. PPE, there is no change, there is no fair value excess on PPE. Therefore 90 plus 25, as it is we can take 150, 90 plus 25. We go line by line. The second line, investment, we have to take investment, it goes to cost of control account. Look, investment 32, we have taken into cost of control, right? Then third line, net current asset. Net current assets, no change, we take as it is. Then next on stated capital, parent stated capital as it is, we have to show on the face of the statement of group statement of financial position. It should be in this one, no? Made a mistake, huh? I ticked off everything in the other one. This one done, this one and this one. Yes, fine. This is done. cost of control. Next line, retained earnings, group retained earnings. Usually what you can do, you open another account called group retained earnings and write it as balance brought forward on group retained earnings, that is 80,000. And their subsidiaries retained earnings 19,000. This is also balance given. Now after this we have taken all balances given in the question. Understood? Not in that, this one, no, sorry. Again I made a mistake, this one and this one. Understand? Right. Now thereafter, look, we have extracted all balances from the question. Now we have taken all these balances. Everything has been taken. What we can do thereafter? Look. It says fair value of NCI is 2,500. The second double entry we learned. Right? Then here fair value of NCI double entry, look again. Cost of control debit, NCI account credit. It's 2.5. Understood? Then the next one, next double entry, pre-acquisition reserves. Look, this 10 debit to subsidiaries retained earnings. Look here, and credit to consolidated cost of control account. It is pre-acquisition retained earnings. Then out of this total 19, look, pre-10 means post-acquisition is about 9. It should be split into 2. Out of this total earnings after acquisition belongs to parent and others. Therefore, 90% of this means 8.8 should be credited to consolidated retained earnings and balance should be credited to non-controlling interest account. Understand? Here debit 9, look again, here debit 9, 8.1 means 90% goes to consolidated retained earnings and 10% means 0.9. 0.9 goes to NCI account. Then this account will be closed. Now here look, final balance, parents own retained earnings 80 plus from the subsidiary 8.1, it is in this one, look, retained earnings. Also NCI, look, fair value of NCI is 2.5 and at the same time from subsidiary we earn 0.9 reserve. So altogether 3.4, it is in this. And also one more thing, I missed that actually amount. Share capital of subsidiary I didn't mention, this sum. It goes to, because it is part of equity, therefore as it is we need to take it into cost of control account. Then look, in cost of control account, we have investment of 32, fair value of NCI 2.5, share capital 20, pre-acquisition retained earnings 10, then my goodwill will be, look, my goodwill is how much? It is 4.5. My goodwill is 4.5, it will come into my balance sheet. Then this will be balanced by 171.5. Understood? So that's how we do this group financial statement with 2 adjustments. Now in this actually we practice 3 double entries very simply. What are the 3 double entries we practice? 1, fair value of NCI, cost of control debit, NCI credit, pre-acquisition retained earnings, subsidiaries retained earnings debit, cost of control credit, post-acquisition retained earnings we split it into 2. Parent portion goes to NCI, here look, sorry, parent's portion goes to consolidated retained earnings and balance goes to NCI. So then this account will be closed, then thereafter you take these 2 balances and put into your consolidated financial statements. Right. Look for this question. Now in this case, fair value of NCI is not given directly. I told you if fair value of NCI is not given directly, how to calculate it? If fair value of NCI is not given directly, how do you calculate it? I told you how to calculate it. If fair value of NCI is not given, market price per share, you take market price per share into number of shares which is not purchased by the parent. That means NCI number of shares. It will be fair value of NCI. Look the way that we have calculated in this question. Read the question first. Parent acquired 75% of the shares in subsidiary on 1st January 2013 when its retained earnings was 15,000. The market share price of subsidiaries shares just before the date of the acquisition was 1.60. Also it says further P value is NCI at fair value. Goodwill has not been impaired. Now look, it says just before the acquisition, what is the market price per share? It is 1.60. How many shares do they have in their accounts, in the subsidiaries account? It's 50,000, it is 1 rupee share. Look, it is 1 share. So then from this 50,000, parent will buy 75%. It means 37,500 shares. Parent will not buy, it means it is belongs to NCI or others equal, other shareholders. It is 25%, means 12,500. Therefore look here, 12,500 shares will be purchased by others, not by the parent. Oh, here P, right? So therefore what you can do, this number of shares that the parent is not bought should be multiplied by market price per share. It is 1.60. Then fair value of NCI will be 12,500 into 1.60. It means exactly 20,000. Look, 20,000. Then what's the double entry for fair value of NCI? Already we have learned. What's double entry for fair value of NCI? Yes? Anybody? Double entry is, yes, cost of control account debit and NCI account credit. Look the way that we have accounted for this 20. NCI account credit 20, look, and cost of control debit, fair value of NCI debit 20. We calculated it and recorded in this question. Understood? Then we again go line by unload one more double entry. What is this? Look, at the time of acquisition, the retained earnings of the subsidiary is how much? 15,000. Then what should be the double entry for this 15,000? We already learned pre-acquisition reserves, double entry, retained earnings of subsidiary debit, retained earnings of subsidiary debit, and we have to credit. Here debit, cost of control credit. Look, it came from this. Right? That is, these are the only two double entries we need to practice in this. One more double entry, that's about post-acquisition reserves, but only additional point here that we take is, if fair value of NCI is not given, how to calculate fair value of NCI? It is the only point we learn in this question. Understand? Right. Thereafter we can go line by line. Here for this thing no change, therefore we can take as it is 110. Already it has been there. I will see, go into this 110. Look, and the next one is investment in shares of subsidiary 68,000. You know it goes to cost of control 68,000 here. And next one is current assets. Sum of these two 52 plus 35 means 87. It's there, look. No change. Then share capital 100,000 as it is, we take on the face of the balance sheet, parent son. Also subsidiary share capital, straight away we take into cost of control account to calculate net assets on the acquisition date. The share capital remain unchanged, therefore we take as it is into this one. It is 50. And retained earnings, parents retained earnings, we take into every time consolidated retained earnings. Look, group retained earnings brought forward, this is brought forward 70. And the subsidiaries retained earnings 25, we record here as brought forward. Subsidiaries retained earnings 25. Then out of this 25, question says 15 prior to the acquisition. It means balance 10 should be after acquisition. We call it post-acquisition reserves. Then post-acquisition reserve should be split into two, like we did in the previous question. The parents portion comes to the group retained earnings, look here, to this one. And the others, this part goes to NCI account. Right? So that means 25%. 25% means 2.5, not 25 there, it should be 2.5. Right, then finally you can close this NCI account. Sorry, before that goodwill, look here, it's 23, we have taken into this one. And group retained earnings balance is straight away we have taken into this. And the NCI balance as it is we have taken into this one. That's it, then this account will be closed. Just close already. Look, just see about this question quickly. Now quite similar question. And ping and pong. Again same thing, only one additional point we are going to learn in this question. It's about receivables and cancellation of receivables and payable. It will be the fourth point we are going to learn relating to intercompany cancellation of receivables and payable. Just read the question quickly. Right. Hope you can hear me now. Take this one. Right. Look now, in this draft financial statement, Ping and Pong Company, it's on 2013, and accordingly you can see 80% of acquisition here, and retained profit on that date 6,000. So also there. There is another new point here. Look, what's this? And also there's total receivable of Ping company is from Pong company is from Ping, and the balance represent the cash in transit. Look, we are going to learn another two things, not to object through. With this question, we are going to learn another 3 points. Better if you listen to this video, you have to summarize all these double entries somewhere. Because in one question, I am taking 1 or 2 double entries. Already, what are the double entries we have taken, which we have to use in group accounts? One is fair value of NCI. Double entry is cost of control debit, NCI account credit. Another one, fair value excess of PPE. PPE debit, cost of control credit. Under provision of depreciation on the same, subsidiaries retained earnings debit, PPE or accumulated depreciation account credit. Another one, if you can remember, pre-acquisition retained earnings, subsidiaries retained earnings debit, credit to cost of control account. Post-acquisition retained earnings, debit to subsidiaries retained earnings and credit to group portion to consolidated retained earnings and subsidiaries portion to, or no, subsidiaries portion, we call it others, or NCI portion to NCI account. Then here we are going to learn, actually there are a few adjustments. One is the 6,000, already we know how to record this 6,000, right? What's double entry for the 6,000? This date is not clear, that's my question here. We'll see wait 1 minute. Right, let's see. Assume this is not clear. Assume the company purchase, we are going to learn something now. Assume company purchased this investment on 1/4, assume 1/4 15, and now we are reporting these balance sheets are given. The date is not given, no? Cut this one. Because date is not, acquisition date is not given, right? This is at 31st, let's assume 31st March 16. Now these balance sheets are given as at I'm going to change something for this. 31st March 16. Understand? Acquisition happened, let's assume acquisition date is 1st April 2015. I just change information for your reference. Understand? I change this information. Just to learn another additional point from this question. We are going to learn few, actually 1, 2, 3 points from this question. 3 new points. Let's see. Right, we will go ahead as usual. PPE line by line. Sorry, before that we can put some double entries on this. No? What is double entry for? Now I'll take these accounts. Now here my balance sheet. I'm going to do this work originally. This is my cost of control account. This is my, look, consolidated retained earnings. This is my NCI account. This is my subsidiaries retained earnings. Right. These are accounts. Then what is double entry for this point? This 6,000 retained profit on the acquisition. Now remember my acquisition date here according to this example. Remember my acquisition date is 1st April 2015. I have changed the answer, right? Change the question model. Accordingly, now on the acquisition date, I have 6,000 retained earnings. Then what should be the double entry for these retained earnings? We call it post acquisition retained earnings. I'll do it in thousands. Here debit 6,000 and credit to cost of control 6,000. We call it retained earnings, pre-acquisition retained earnings. This is pre. Right? This is one thing. Also now we have completed up to this level. The total receivable of Pong company means subsidiary is from Ping company. Total receivable, look, there is a receivable of 16,000 in this balance sheet. Look carefully. Also there is now trade receivable from Ping. Look, Ping means some. Sorry, made a mistake. This is trade receivables. Receivable from, made a mistake. There is a receivable of Ping company 10,000. I will erase it. Wait 1 minute. Right, now fine. Receivables from Ping company 10,000. Now here look, owed to Pong company it's 8,000. What do you think about this? Now what it says, because based on this balance, the Ping company, the subsidiary, this is subsidiary, this is subsidiary, look, this is subsidiary, this is parent. Subsidiary says there is a receivable from parent of 10,000. But what parent says, no, there is only payable of 8,000 to subsidiary. Understand? This difference because of this cash in transit. Look, another entry we are going to learn now. Understand first the meaning of these two amounts. These two. Subsidiary says there is 10,000 receivable from parent. But parent says there is only payable of 8,000 to subsidiary. There is a mismatch. Why it has happened like that? Reason is, what has happened? This should be actually not cash. Better to say it as check in transit. Cash, because usually we don't check. We don't send cash by post, no, very rare. Right? So what we do, we send check by post, by mail. We call it check in transit, right? So then what we can say, Actually, what has happened here, now this difference between this 8,000 and 10,000 arise because of parent has sent a check to subsidiary, but subsidiary has not received this check at the end of, by the end of the year. Since parent has sent it, parent has subtracted from this, but subsidiary has not subtracted from this. Understand? So therefore, what we need to do, we call this difference check in transit. Check in transit. Now what has happened actually? There is actually receivable and payable of these two. There is a check in transit of 2000. Anyway, we know check in transit is an asset to the group. It's on the way. So therefore, I will take this check in transit. We call it check. I will write it here. Check in transit of 2 should be recognized as debit balance. Check in transit debit, and I am going to credit it into this payable account credit 2. Look, the double entry for check in transit. Double entry for check in transit, parents payable credit 2, then it will become 10,000. And check in transit debit 2. Right? There is a theory. Theory says if there is any intercompany receivable and payable, it should be eliminated in full. It should be eliminated in full. Understand? Therefore, what you have to do is, now here look, subsidiary says there is a receivable from parent. Parent says there is a payable to subsidiary. Understand? Therefore, double entry should be, what should be double entry? Cancellation of this receivable and payable. Cancellation of this receivable and payable. Accordingly, what we have to do? Receivable account debit, sorry, made a mistake. Receivable account credit and payable account should be debited, then it will be eliminated in each other. Understand? The theory says all intercompany transactions should be eliminated in full. Actually, subsidiary says there is a receivable from parent. Parent says there is a receivable from, there is payable to subsidiary. But for the group, there is no receivable or payable. Therefore, what we say in theory, all intercompany receivables and payables should be eliminated in full. Therefore, this 10,000 should be cancelled against this 10,000. Therefore, there is no receivable or payable to the balance sheet from parent and subsidiary. Understand? Actually, we don't want to take anything to the right. We don't take anything to the consolidated financial statements as receivable from subsidiary, sorry, receivable from parent or payable to subsidiary. We don't take those balances. We cancel each other. But we recognize cash in transit as an asset to group financial statements. That's about it. And also goodwill. Look, there is something again. Goodwill is impaired by 25% per in year. I'll come to that point later after calculating goodwill. So hope these are the only adjustments we have in this question. Therefore, we can go ahead with these balances given in the balance sheet. Now, we are here now. PPE, no change. We can, as it is, we can take 90. Sum of that too. Look here, how many ordinary shares they have purchased? 1 rupee each. Huh? Look here. How much of ordinary shares do they have? Out of this, they have taken 20,000 shares. That means 20 over 25. What is the percentage? %. Look, that is matched with 80%. Look, it is given anyway. Now, anyway, investment. Now we have completed this figure. Now we are in this figure. Investment made by parent in the subsidiary we take into every time it goes to cost of control account, it's 20. 20, no? No, not 20, sorry, 30. Investment 30. Next item, inventory, there is no change of inventory, we can take as it is. Then 8,000 plus 3,000, inventory is 11. Here there is a trade receivable of 16. No change, as it is we can take. This receivable we already cancelled, this 10,000 already cancelled. Cash we can take now as it is. 2 plus 7, cash in hand 9. This total, right? Parent share capital 45 and subsidiaries one is 25, then share capital we can take as it is 25. Yes, no? Sorry, 45. 45. Subsidiary share capital 25 we take into, subsidiary share capital we need to take into cost of control account to calculate net assets on the acquisition date, 25. And now we have taken this one also. Revaluation surplus, there is revaluation surplus, but there is no evidence that revaluation surplus is happened just after the acquisition. Therefore, anyway, parents revaluation, then revaluation surplus, $12 we take as it is. That, what about this subsidiaries? What do you think about this 5? Is it earned after acquisition or before acquisition? I told you here the acquisition date is 1/4/15, reporting date is 31st March 16. What do you think about this revaluation surplus of 5,000? Is it arised after acquisition or before the acquisition? What do you think? Anybody? There is no evidence to say that this 5,000 has been earned after the acquisition. Therefore, probably you can guess that this 5,000 revaluation surplus earned prior to the acquisition. Understand? It means it should be considered to calculate net assets at the time of acquisition. So therefore, it should be taken as pre-acquisition revaluation reserve. Therefore, I'll take it into revaluation reserve, I'll take it into cost of control account. How much it was? 5. Assume that, not assume actually, there is clear evidence. This 5 earned prior to acquisition. Then next one is group retained earnings 26. Consolidated retained earnings 26. Shall I erase this and take? There is no space. This is consolidated retained earnings. I will write it again. And subsidiaries retained earnings here it's 28. Right. Now this balance already we have cancelled together with payable in the other side. Other trade payable we have take this 17 as it is. Now here I will write trade payables, That's all about figures. We have taken all figures given in the balance sheet. Now what do you think about the fair value of NCI? In this case, examiner is silent about fair value of NCI. They are not talking about anything about fair value of NCI. So therefore, what do you think about fair value? How can you calculate? Now I told you there are three methods to recognize fair value of NCI into accounts. One method, if examiner has given fair value of NCI, so then you have to record it as cost of control debit, fair NCI account credit. If it is not given, but the share price is given, share price of subsidiary is given, what you can do is take subsidiary's share price into subsidiary share price on the acquisition date into NCI shares, then you can find fair value of NCI. Now in this question you can see fair value of NCI is not given, even share price is also not given. Then I told you another method. You take total equity at the time of acquisition. Take total equity at the time of acquisition and multiply it by NCI percentage. Now look here in this example, total equity on the date of acquisition is how much here? 25, 30, 36. Understand here 36. 36 total. That into, you can take this into NCI percentage is 80% will be 36 into 80%. Acquisition percentage is, as I remember, 80%, no? Yeah, 80%. 36 into 80% means 28.8 will be fair value of NCI. Their credit, NCI account credit 28.8. Now we have calculated fair value of NCI as well. Now here we have another one. What is this? Total retained earnings now we have 28, out of this pre-acquisition 6. Means post-acquisition is how much? 22. What we have to do for this? 22 should be split into two portions as 80% and what is the balance? 20%. Then 22 into 80%, it's 17.6 goes to consolidated retained earnings and balance 22 into 0.2, it means 4.4 goes to where? Look, NCI account. Understand? Then this account will be closed. Understand? Right. Next part. Now subsidiaries retained earnings already closed. Now we can close our cost of control account to calculate goodwill. Look, how much is it? 30 plus 28.8 minus 6 minus 25 minus 5. My goodwill here is 22.8. This is my goodwill account. Look, I will open it into goodwill account. This is my goodwill. $22.8. But question says, now actually this I told you, in this example acquisition happened exactly 1 year back. 1 year back means look and see, I told you the acquisition happened on 1st April 2015 and now we are reporting these balance sheets are given as of 31st March 16. Therefore, what you can do? There is a point here, goodwill was impaired by 25% in the year. That means during the year, goodwill has been impaired by 25%. It means now, what do you mean by goodwill here? Business combination goodwill, look. The group goodwill or consolidated goodwill here is 22.8. Out of that, the 25% has been impaired during the year. What do you mean by impairment? Impairment here means like, very simply, according to LKS 38, there are two types of goodwill: internal generated goodwill and external generated goodwill. Actually, goodwill arise on business combination is part of external generated goodwill, but the business combination will allow us to recognize this external generated goodwill. That's what we did here. Impairment means very simply the value decrease in value of goodwill. At the acquisition date, the meaning here, according to accounting terms, there is goodwill of 22.8, but during the year it has been reduced or decreased by 25%. It means we have to recognize it as an expense. Now, new double entry we are going to learn. Look here very carefully. New double entry for goodwill impairment. New double entry for goodwill impairment. What's double entry? Anyway, if it is impaired, the value will be decreased. It's very clear. Therefore, double entry should be 22.8 into 25%. According to this question, it says there's decrease of 25%. Therefore, 5.7%. Sorry, 5.7. Here credit and debit to, remember, group portion to consolidated retained earnings. It means 80% of this means 4.6. The original value is 4.56, but I will take it as 4.6. This is impairment. And this is also impairment total. And balance 5.7 minus 4.6 means 1.1 we charge to NCI as impairment. Understand? Look now, hope you have learned double entry for impairment of goodwill, it's new one. What's double entry for impairment of goodwill? Goodwill account credit, group portion we debit to consolidated retained earnings, and subsidiaries portion or others portion we debit to, or NCI portion we debit to NCI account. Understand? Now what is final value of goodwill? We had 22.8 minus 5.7. Final value of goodwill is, look, goodwill is 17.1. Understand? It is balance of this. Now this account also closed. Now we can close consolidated retained earnings account, that is balance 26 plus 17.6 minus 4.6 means the here balance will be 39. I'll take that as closing balance. We write here as consolidated retained earnings 39, and NCI balance will be how much? 28.8 plus 4.4 minus 1.1, it is 32.1. Then NCI balance 32.1. Now you can close this the balance sheet. You can see whether it is balanced. 90 plus 17.1 plus 11 plus 2 plus 16 plus 9. This side is 145.1. Let's see whether it is balanced. What about other side? Seems like not balancing. 45 plus 12 plus 39 plus 32.1 plus 17. Yeah, it's balanced. This side also 145.1. It is balanced. Look. Then what are the new learnings we had here? Actually, we had 3 new learnings in this question. What are the 3 new learnings we had? One is, actually, we were not given the fair value of NCI. Examiner is silent on this. Then how did you calculate fair value of NCI? Remember, we took total net assets on the acquisition date. Means now total net assets, look, on the acquisition date we had retained earnings 6. On the acquisition date we had share capital 25. On the acquisition date there is a revaluation reserve of 5. Altogether It is 36. Out of 36, we took 80% as. Wow, 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 wow. I made a mistake. What's the mistake I did? What is NCI percentage? I made a mistake here. I had to redo now. Wait, wait 1 minute, I'll rectify it. Here only not 80% no. Fair value of NCI is how much? It is only 20%. Nobody said it. 36 into 0.2, it's 7.2. My God, this is wrong. Accordingly, everything should be changed now. My goodness, what we can do? I'll erase and do it, otherwise it will be a problem. Then this should be changed. 1 minute. I'm going to change some amounts. My goodwill calculation is wrong because fair value of NCI is wrong. Fortunately, I got it. I'll use blue color and write. Now, fair value of NCI is not actually 36 into 0.2. It is 7.2. I made a mistake here. Fair value of NCI is 7.2. I made a mistake. $7.2. Then my goodwill also wrong. My God. My goodwill will be how much? Let's see. Is it goodwill or negative goodwill then? No. Fortunately, goodwill 30 plus 7.2, 37.2 minus 6 minus 25 minus 5. Oh my God, it's only 1.2 goodwill, small amount. Takes time again now. Goodwill is 1.2. It is impaired by only then 25%. 1.2 into 25% means it is impaired by 0.3. Look, impaired by 0.3, then final goodwill balance will be here 0.9, 0.9. Then impairment out of 0.3 we have to charge 80%. It's 0.2 here and here 0.1. Now I can find closing balances of these accounts. 7.2 plus 4.4 minus 0.1. Here NCI balance will be 11.5. I made a mistake previously. NCI 11.5. Here the balance 26 plus 17.6 minus 0.2. It is 43.4. Here 43.4. Yes, correct. This will be then. This also should be changed. $138.9. The other side also same, I think 45 plus 12 plus 43.4 plus 11.5 plus 17. Wow, 10 difference. What is 10 difference? So here 128, not 138. Here also 128.9. It is balanced by 128.9. 128.9. Right, fine. So hope in discussion I was brief in the thing. Actually I did a small mistake. That's about the calculation of fair value of NCI. I took total equity on that acquisition date, but I multiplied by 80%, but it should be on 20%. I rectified it. So then double entry for fair value of NCI is debit to cost of control and credit to NCI account. It's about 7.2. It is 1 point we learned. Since it is not given, we took the total equity on the acquisition date and multiplied by NCI percentage to find out fair value of NCI. It is first point we learn in this question, and the second point that we learn is about cancellation of intercompany receivables and payables. Accordingly, we cancel intercompany receivables and payables in this one, if you can see, and we recognize checks in transit into the books of accounts. Another point we learn. Also, the third point we learn from this question is impairment of goodwill. If there's any impairment of goodwill, the double entry should be goodwill account credit and debit to consolidated retained earnings account, the group portion, and NCI portion debit to NCI account. So that is about double entry for impairment of goodwill. Remember again, I don't have space, right? Actually, write somewhere here. I'll write double entry here. Impairment of goodwill. Double entry, consolidated retained earnings debit. It is about group portion. NCI account debit. This NCI percentage, and credit to goodwill account credit. Total amount. Impairment of goodwill, double entry, consolidated retained earnings debit, NCI account debit, goodwill account credit. Right, that's fine. That's all about it. Right, let's see about another question, example number 10 here. Just read it quickly, just run through this question and see. Right. Let's see. Different kind of question. Now we are going to practice everything that we have learned up to now plus some more. Right. Then there is statement of financial position as of 31st December 2015. Right. PP is there. Investment is there. Then inventories, trade receivables, cash, equities and liabilities. Under that equity shares, retained earnings and current liabilities. Right. Those are the balances there. Look, adjustments. A Limited purchased 75% of shares. It's clear, 75% of ordinary shares. In B Limited on 1st January 2014, look this date. How many years back? What is our reporting date? It is about 15th December. Now if you can remember, if you draw a timeline, now this was purchased on 1/1/14. But here 31st December, we are now in 31st December 15. How many years back? 14 and 15, 2 years back actually. Now we are reporting on this date. This is our account in year. Right? This is our account in year. But prior to 1 year, we have purchased this investment. At the same time, retained earnings on that date, 50,000 means, what is it? Pre-acquisition reserves. How much pre-acquisition reserve? Pre-50. Therefore, these are my accounts. This is cost of control. This is my consolidated retained earnings. This is actually, I'll take as NCI. I'm not sure that I have enough space. And this is, let's say, subsidiaries retained earnings. This is cost of control, remember. This is cost of control. Then double entry, first on pre-acquisition reserves, debit to subsidiaries retained earnings, and credit to, cost of control credit 50. This is pre-acquisition retained earnings. Then second point. The fair value of land which is not depreciable, land means kind of asset which is not depreciated. The fair value of a land of B Limited, B Limited subsidiary, was 75% when the book value was 60,000 as of the acquisition date. That means on the acquisition date, there is PPE, big amount of PPE here, right? Inside this PP, there is a land which has a value of 75,000, but its book value is 60. Then what is this difference? 15. We call, already we have learned this point. This is fair value excess. Understand? Hope you can hear me now using this mic. Now fair value excess is 15. Why? The land value is 75, but the book value of this is book value. This is market value or fair value. That difference we call fair value excess. Then what's double entry for fair value excess? All we have learning. Double entry for this is PPE debit and we have to credit. Cost of control account credit because it is kind of reserve. We call it your revaluation reserve at the date of acquisition. Understood? Therefore, you charge it to Thayaraj. Thayaraj, you need to say something. Okay, fine, right. Right, then hope you can hear me because I'm not using the clip-on mic, I'm using this stable mic. Right, fine, go ahead. So then fair value excess double entry is, I told you already, there's a fair value excess, then I'll debit it to PPE, therefore I'll write as it is here. PP debit, how much was excess? 15. I just write it is as 15 plus. And credit to consolidated, cost of control as fair value excess. Fair value excess of land, 15. Credit there. So done. Now this is done, this is done. Now there is another new one. Look. From each question we are going to learn at least 1 or 2 new points. Again we are going to learn another 2 new points. Hope up to now actually I told you consolidation is kind of series of lectures. After all these, the first day we learn only few. Today actually I added few. At the end of the day, I summarize what are the points we learn, what are the entries we learn. Actually, these are different types of adjustments we learn. Right? From each question you have something to learn new. In this question, what it says about the fourth bullet, if you see, there was an intangible asset of 12,000 as of the acquisition date, and it was not recorded in the books of accounts of B Limited. B Limited has not recorded this intangible asset in their books of accounts at the time of acquisition. But here examiner says you are allowed to recognize this intangible asset. Understood? So now also they say the lifetime of the intangible asset is 4 years. We know if you recognize any intangible asset, it should be amortized over its useful lifetime. Now remember, on the other hand, this is 1 year and this is the last year. Actually this acquisition happened 2 years back. Now there is intangible asset of 12 here. It has not been recognized in books of accounts, means for the consolidation purpose, we have to recognize this 12,000 into books of accounts. How do we recognize this unrecorded intangible asset into books of accounts? Unrecorded intangible asset, we will record it now in group accounts, since it is not recorded. How to record it? I'll write double entry here. What's double entry for this 12? Intangible, group intangible debit. Group intangible debit, and where to credit? Cost of control account credit. Why? Why do credit to cost of control account, even though it is an asset? If you record any kind of asset at the time of acquisition, what happens to your net assets? When asset goes, obviously your net asset goes up. Understood what I said? Net asset means very simply, asset minus liabilities. Asset minus liabilities means net assets. When asset goes up, what happens to my net assets? It goes up. Therefore, as a result of recognizing this intangible into consolidated books of accounts, what happens to my net assets? It goes up. Therefore, all net assets at the time of acquisition, we know we have to recognize into group financial statements, so group cost of control account to calculate goodwill. So therefore, I credit it to cost of control account. Look here, intangible asset account debit, I'll take it as intangible. Intangible debit 12 plus 12 here. I just put plus 12, we will finalize these later. Intangible debit 12 and credit to cost of control here 12. This is intangible. Understood? Right. That's all about adjustments. what about right, pre-acquisition reserves done, and this thing. One more thing. Sorry. Lifetime of the intangible asset is 4 years. Now, how many? Now, actually, we are now here. We are reporting on this date. Now, this intangible asset already we have recognized in books of accounts on this date. It means how many years back? It was around 2 years back. But total lifetime of this intangible asset should be 12. Should be 4. Then what is amortization of intangible asset? This 12 should be divided by how much? 4, and into how many years gone? 2 years gone. It means for per annum we have to amortize 3 as amortization charges of this intangible asset. Intangibles are amortized. It's like depreciating tangible assets. Therefore, 3 for this year and 3 for this year should be amortized from this intangible asset. Then it means my intangible asset account balance should be decreased. Double entry for amortization. Look, the second point we are learning, second new learning point from this question is amortization is 6 total. Here credit and consolidated retained earnings. Oh, who is doing this actually? Amortization part. Whose intangible asset this? Is this? It is subsidiaries intangible. Therefore, we debit into this as amortization. Amortization of does happen. I can't write now suddenly. Amortization 6. Something happened. Let's see whether can't write now. Now it's okay. Fine. Amortization 6. Fine. The double entry for now. First point we learned unrecorded, how to recognize intangible asset which is not recognized at the time of acquisition. Then how to recognize it? Intangible asset account debit, cost of control account credit 12. But it has been amortized over last 2 years because the total useful lifetime of this intangible asset is 4. So this acquisition happened 2 years back. Therefore, for 2 years we have to amortize this intangible asset. Therefore, what I did, 12 by 4 into 2 for 2 years, then 6 should be amortized. Then double entry is subsidiaries retained earnings debit 6 and intangible asset account 6. Then finally here balance will be only 6. Right? I can write again. Yes, right? 6. Now we have considered all accounting entries. Now we'll go line by line through this. Now PPE, first line will take 240 plus 200. 240 plus 200. Not only that, what else? We added how much? Something has happened today. We added 15 if you can remember. What is it? Fair value of land. Therefore, total will be PPE balance should be 455. I'm going to type all these now again. We can't write. Next line, we'll go back and see. Investment in B, subsidiary 220. Very simply, we put into cost of control 220. Next line, inventories, no change, 75 plus 60. Here 75 plus 60, 135 inventories. I'll write it here. Inventory 135. I'm going to type everything now because we can't type it today. Something has happened. And next one, trade receivables 105, no change. $105. What else? Cash, no change 20. I'll take as it is. Cash here is 20. Right. Now what else? Parent share capital here, now we are here, 250 and subsidiary 120. Parent share capital, I'll take as it is here. Share capital 250, subsidiary is 1 as it is, we take cost of control account 120. This is share capital. Share capital of subsidiary 120. What else? Parent's retained earnings is 180, subsidiary is 190. Here brought forward 180, here brought forward 90. Something has happened, we can't write now today. That's why I type everything. Current liability is no change, 280 as it is we can take. Yeah, I'll take current liability. It was 280. Correct, no? Yes. I have taken almost all the balance. Now here look, we will start, fair value of NCI is how much now? It is not given, I think. Yes, fair value of NCI is not given. Therefore, we have to calculate it now. What is fair value of NCI? I told you take total equity on that date. I'll write it here. Fair value of NCI equal 50 plus 15 plus 12 plus 120 that into point or 20%, not 25%, no? How much is it? Let's see. 50 plus 15 plus 12 plus 120 into 0.25 because acquisition percentage is 75. So then it will be equal to 49.25. I'll take it as 49. Fair value of NCI is then fair value of NCI 49. Double entry cost of control debit here fair value of NCI 49. I made a mistake. Here, sorry. NCI account credit. It is done. Then here we can see pre-acquisition reserves. How much is pre-acquisition reserve? 90 minus 56. 90 minus 56. Pre-acquisition 34. Then this 34 should be split into 2 if you can remember. 75% and I can't write today why it has happened. 75% and 25%. 75% we charge to consolidated retained earnings. 34 into 75% means 34 into 0.75 means 25.5. This is post acquisition retained earnings of subsidiary 25.5. Right? And balance goes to NCI. Post acquisition retained earnings of subsidiary it's 25.5. Then this account will be closed. Something has happened, we can't write today now. And what's about my goodwill? Let's see, what is goodwill? Now here you can find goodwill on consolidation will be how much? 220 plus 49 minus 50 minus 15 minus 12 minus 120. My goodwill is 72. It is goodwill on consolidation. 72 I charge to this thing. Balance sheet. Goodwill is 72. Then consolidated retained earnings we can take as it is, no problem. Consolidated retained earnings. 180 plus 25.5, 205.5. My NCI balance will be, non-NCI balance will be 49 plus 25.5, 49 plus 25.5 is 74.5. Now you can see the total balance here finally. 455 plus 6 plus 72 plus 135 plus 105 plus 20. Yeah, fine, something happened again. 793. Balancing figure is 793. We'll see whether it is same here this side. 250 plus 205.5 plus 74.5 plus 280. What is that? It's not balancing. 250 plus 205.5 plus 74.5 plus 280. Wow, there is a difference. What is my NCI balance? 49 plus 25 point plus 49 plus 25.5. 74.5. It's correct, NCI. It's wrong, sorry. This balance is wrong. Sorry. Not 25.5. I made a mistake. Yes, it is wrong. The balance should be 34 into 0.25. It's 8.5. Yes, sorry. NCI 8.5. Thank you, Perera. Then my here balance, NCI balance should be not 74 something. 49 plus 8.5. It is 57.5. Now just see the balance, it should be balanced anyway. 250 plus 205.5 plus 57.5 plus 280. Yeah, it's 7. It's not a magic actually. So we have posted all double entries, therefore it should balance. Anyway, final answer will be by 793. Right, that's all about from this question. So then what do you learn from this question finally? So we learn one point, how to recognize unrecognized intangible assets into books of accounts at the time of acquisition. Also we learned about amortization, how to amortize what is called intangible asset over the period of 2 years. Right, now up to now, if I summarize everything, we have learned several points. We learned about cost of control and calculation of goodwill and profit on bargain in purchase. So those are the points we have learned. I'll just summarize everything here, just for your understanding. Cost of control and calculation of goodwill. These are the points we have learned. Second point, we learn about NCI and fair value of NCI. We learn double entry. What's double entry? Cost of control, debit, NCI account credit. Thereafter we learn post acquisition and pre-acquisition reserves. If it is debit to reserve account, credit to cost of control. If it is post acquisition, debit to reserve account, credit to consolidated retained earnings and NCI. It's done. Thereafter we learn fair value excess of PPE and under provision of depreciation. Fair value excess, PPE debit, cost of control credit, under provision of depreciation on the excess, depreciation account credit, made a mistake. Yeah, depreciation of asset account credit, subsidiaries retained earnings debit. Thereafter we learn here under NCI, actually we learn that calculation of NCI also. Calculation of NCI also we learned, yeah. Then we learn impairment of goodwill, double entry, consolidated goodwill account credit, consolidated retained earnings debit, NCI debit for impairment of goodwill. Then we learn recording of intangibles at the date of acquisition, intangible account debit and cost of control credit. Also we learn amortization on the same, amortization of profit and loss account debit, intangible asset account credit. Also we learn intercompany cancellation of debtors and creditors. Intercompany cancellation of debtors and creditors. We learn how to cancel. What else we learn as adjustments? Anything more? Yeah. look, these are the points we have learned up to now. You have to update these few points and come for the next lesson. I'll stop little early today and we will cover that time. We have learned 1, 2, 3, 4, 5, 6, 7, around more than 10 points we have already learned. Right, so therefore these are the learning points you have to remember for the consolidated financial statements. I need to do actually 2 more, that is intercompany trading of fixed assets and intercompany trading of, those are the new 2 we have to learn actually. Intercompany trading of fixed assets and inventories. After learning these, we can complete the balance sheet adjustment, right? So then I'll come up with this next week. So remember, you have to update this knowledge up to this level, and I wish you a very happy new year to everybody. Since today is the last lecture for accounting stream for this year, and hopefully you will be able to complete your degree within next year. So therefore I wish you very best to have a very happy new year at 2017 also. Remember, actually I hope that you will be able to complete your degree within next year. So make all possible efforts to complete the degree, then it will be obviously a good new year to have kind of new qualification to you all, right? So therefore all the very best, and we will see again in next year. And that's it for the day, and again we will see next year. Thank you very much for wishing me, and inform everybody that I wish everybody, and I'll send a mail also later. Okay, thank you very much for participating today. So let's see, let's meet again in next year 2017. Bye.